Welcome to the Daily Drawdown, your fast brief on rates, energy, AI, and market risk. The market got three messages at once. Treasury is trying to steady long bonds, oil risk is back in force, and AI capex is getting big enough to matter for rates by itself. That combination matters because it hits inflation, financing costs, and risk appetite all at the same time. Treasury said it will buy back at least $4 billion per operation in longer-dated treasuries, roughly $16 billion through November, and left the door open to doing more. The practical read is straightforward: finance some duration purchases with short-term bills and try to improve market functioning at the margin. The market mostly treated it as a signal, not a game changer. The 10-year briefly dipped, then moved back near 4.7%, and the 30-year pushed above roughly 5.25 to 5.33%. That tells you the core issue. A few billion dollars is symbolically important, but mechanically small against a multi-trillion long-end market and ongoing issuance. The risk is political as much as financial. If buybacks show up around weak auctions or election pressure, traders may read that as soft yield management and test how serious Treasury really is. It also revives the coordination question. Once Treasury is leaning on the long end, while the Fed is still managing inflation, markets start asking where debt management ends and policy support begins. Underneath all of this is the same fiscal backdrop. Roughly $40 trillion in public debt and a debt-to-GDP ratio now in the upper 120s after being below 100% before COVID. There has been some improvement. The deficit has come down from about 8% of GDP in 2023 to just over 7% early this year, and more recently around 5.9%. That helps, but it does not solve the structural problem. Entitlement spending still eats more than 2/3 of the federal budget, so markets are not going to treat modest progress as a clean bill of health. Why it matters is simple. If rates stay high, fiscal flexibility shrinks, and every attempt to smooth funding costs gets read through the lens of credibility. Oil is the clearest near-term macro risk. Brent has been cited from the high 80s into the mid-90s, and traders are openly talking about 100 to 110 as a plausible next stop if supply risk worsens. The tail risk is the Strait of Hormuz and Iran-linked disruption. Flow estimates vary, but the point is the same. A meaningful chunk of global supply is moving through a choke point the market may still be underpricing. This is not just a crude story. Refining utilization is already near capacity. Diesel margins are unusually high, and that broadens the inflation hit well beyond the pump. Reported consumer impacts are already large enough to change behavior, with gasoline above $4 a gallon and diesel near $5.55 in some readings. That creates a direct policy conflict. Higher energy inflation pushes the Fed toward tighter policy or at least a longer hold, while politics is pushing the other way toward lower rates. The latest Fed minutes showed a 9-3 hold, with 3 dissenters wanting a 25 basis point hike. That is a reminder that the committee is not uniformly comfortable with inflation where it is. A lot of strategists still see the 10-year living in a 4 to 5% range unless growth breaks lower or inflation cools materially. The newer issue is that capital demand itself may be lifting the floor under yields. If AI infrastructure, energy systems, and public borrowing all need long-duration financing at once, the neutral rate may be higher than markets got used to in the last cycle. That is where the AI story stops being just a tech story. Some bull case forecasts now put cumulative AI capex above $14 trillion from 2026 through 2030, or roughly $2.5 to $3 trillion a year. The sequencing risk is the key point. Data centers, power, cloud build-out, and inference spending hit now, while the productivity payoff arrives later, if it arrives at the scale being promised. In the meantime, hyperscaler debt issuance competes with Treasury supply for the same pool of long-term capital, which can put upward pressure on yields before AI lowers costs anywhere else in the economy. Investors are moving into a show-me phase. Anthropic could file sooner, potentially in September or October, and OpenAI has reportedly pointed employees toward a 2027 IPO. Those S1s matter because they should finally show whether model companies have durable recurring revenue strong enough to justify the infrastructure race. There are also hard real-world constraints: power, water, local resistance, and moratoria. Some projects are far more politically and physically constrained than the top-down CapEx numbers imply. Micron is one of the purest expressions of that build-out. The company argues memory is now strategic AI infrastructure rather than a plain commodity, and some commentary put demand at many times current supply. The bull case says shortages and pricing power can persist into late 2028 or early 2029. The bear case is the old semiconductor lesson. Everyone adds capacity at once, and the cycle eventually punishes it. Micron's U.S. investment plans show the scale of the bet, roughly $250 to $260 billion overall, including about $50 billion for 2 Boise fabs and a $10 billion research facility. For Boise, that means jobs and wealth effects, but also pressure on housing, traffic, water, and power. Locally, it is a boom story. Financially, it is still exposed to the same global memory cycle risk as always. On the consumer side, Walmart's quarter was a useful reality check. U.S. comparable sales rose about 2.6%, below consensus even as the company raised full-year sales and earnings guidance. The stock still dropped about 9 to 10%, which tells you investors were focused on slowing core momentum, valuation, and the quality of the beat. Management said shoppers are getting more selective as gasoline moves above $4 a gallon. That matters because Walmart usually sees the spending trade-offs early. There were also distortions from pharmacy reimbursement, GLP-1 effects, and tariff refunds. So the clean read is not that the consumer has cracked, it is that higher fuel costs are forcing harder choices at the margin. Crypto joined the broader scarce asset rally. Bitcoin moved back above 70,000, helped by a wave of short covering that was cited around $3 billion over 24 hours. The bigger issue is market structure. Coinbase is pushing for clearer U.S. rules, talking up a Senate vote on the Bipartisan Clarity Act in mid-September, while also expanding abroad with tokenized equities out of Abu Dhabi. Hyperliquid is the disruptive angle. It wants U.S. perpetual-style 24/7 trading, which is why CME and other incumbents immediately came into the conversation. The opportunity is obvious, but sustainable competition still depends on regulation, liquidity, and product design. Fast trading access is not the same thing as durable market infrastructure. First, market breadth has improved more than the headline indexes suggest. Equal weight, small caps, healthcare, energy, materials, and parts of the industrial and AI supply chain have all participated, which makes the rally less fragile than a pure mega-cap story. Second, autonomous AI cyberattacks are moving from theory to operating risk. Reports described agents carrying out thousands of actions without human direction, and cyber insurers are already treating AI as a distinct risk amplifier with tighter limits and coverage uncertainty. That is the setup right now: higher oil risk, a firmer rates floor, and AI demand starting to reshape capital markets, not just technology. You are listening to the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.